Okay, so M&A Basics. And I'm going to do this for you, Matt. We're going to go through this at a little bit of a clip to compromise on the people that really wanted to leave and give it flavor to the people that wanted to stay. Is that fair? Okay. Okay, so most of you may know this, most of you may not know this. How much do I get after tax if I sell my company for $1 million? And that's going to depend on the facts and circumstances. If a C corporation, and this assumes no basis in the corporate assets, no basis in the stock. If a C corp sells its assets for $1 million, the poor shareholders left with $490,000 left over. How do you feel about that, Allie?
Not great.
Not great. Okay, so that's a really bad spot to be in. Sale of C corporation stock after tax on $1 million sale, $700,000 assumes no basis in the stock. Asset sale of partnership or S corporation with no basis in the interest, but this assumes that every asset on the balance sheet is ordinary. So going back to the example where I'm buying Max's company and it has all AR, cash-based AR, and all I'm paying is the amount equal to the AR, that's all ordinary. That's this scenario. That would result in $580,000 of tax. Partnership or asset sale with no basis. The owner's equity interest. This assumes everything's capital nature, and we have $730,000 to $800,000 worth of after-tax proceeds. And the punchline, or an important thing in the middle of this, and sooner or later I'd encourage you to highlight it, is purchase price allocation matters. It's not on this page, but we're going to get there. And that's one of the reasons, that's one of the real drivers in between point C and point D. In general, what are the facts and circumstances determine after-tax proceeds? Is the transaction a C Corp stock sale, S Corp stock sale, or a partnership interest? If so, the following rates apply. Okay? And this is, again, just to be clear, this is a sale of an interest. This is somebody giving A dollars and A transferring equity. Okay? You're not transferring the assets of the company. You're transferring your stock interest, your partnership interest, or your C Corp interest in this fact pattern. Okay? So, the first line is federal. Okay? C Corp, your highest federal rate is 23.8%. Your S Corp is 23.8 or 20%. And your partnership is 37 or 23.8 or 20%. What the hell? Okay? So let's stick on one thing first. Okay? And that is the difference between 23.8, 23.8 or 20, 23.8 or 20. Okay? The difference between those two numbers is 3.8%. Does 3.8% ring a bell for anybody in the room? What is that, Max?
Net investment income.
Net investment income tax. Okay? Do you guys understand what the net investment income tax and when it applies?
Isn't it applied to portfolio income when you're over a certain threshold, maybe 250,000 or something like that?
It does, but this is the sale of stock.
Which is portfolio income.
Well, maybe not.
Okay.
Can be. Sure as hell can
right.
be.
Oh, right. If
It
you're
sure as hell can be.
If you're like an active participant,
Okay.
it's different, right?
Okay, so, all right, you guys might be here a little bit longer than I thought you were going to. I'm not going to go through this as quickly because this to me is actually important. Okay? A C Corp stock is always going to be 23.8%. Always. Because there's no way to escape net investment income tax. And I got A and B in S1 and A and B in L1. And everything all kind of loops together here. Okay? Now, I'm going to put hours. Why the hell am I talking about hours?
With the passive activity loss.
Passive activity. So now we have another hook in the importance of the passive activity rules. Okay? If you're passive with respect to an activity, then the net investment income tax is going to count or be inflicted on or be required for you to pay if you're passive. B is passive. So B, in this case, is going to be your 23.8% or your 23.8%. A, on the other hand, who's active in the enterprise, doesn't have to pay net investment income tax. Code section 1411, for whatever it's worth. Okay, so for a C Corp, it's always, always, always going to have 23.8%. Partnership and S Corp, you need to measure whether you have an active participant or a passive participant to Sam,
Diagnose.
whether the 3.8% applies. Okay? Then you have Nebraska tax rate on the second line, which is 0% to 6.6, and now that's revised down to McKinsey in 2024 to what?
5.84.
5.84. That actually sounds right. I can't remember that, but when you said it, it felt right.
I think that's right.
That does sound right. What is it in 25? I have no idea.
I don't think it's all the way down to 4.99, but
Somewhere in that range.
low fives.
So,
Yeah.
so the point, while I can't articulate what that percentage drop is, over the next 5-6 years
It's only, I mean, we only have 4 years left
for the drop,
of the decline. Yeah.
okay, we're going to have a decrease in the Nebraska tax rate. When this slide was created in 23, that Nebraska tax rate decline did not exist, and you know how I've loved to update my slides. Okay? So, but for purposes, you guys can, actually I would make a note. I would highlight that line and make a note that that tax rate is declining due to Nebraska legislation, solely because it's a good idea to know the tax rate's declining, because in order to consult, we need to know something, and knowing that there's a declining tax rate seems like a good thing a consultant would know.
It'll go down to 3.99, 2027.
I have no idea.
2027.
Should fact check myself.
Okay? So, why do I have 0% to 6.64, which is really 5.84 according to McKinsey? Why do I have 0% to 5.84, or whatever that number is? Okay, and we're going to get into that. But if you want to make a note on this page, there's two things that can drive that tax rate down from a Nebraska. This is solely Nebraska. That can drive that rate down to 5.84% to 0. And that is the Nebraska capital gains exclusion on the sale or exchange of stock, or in the alternative, if, remember when not McKinsey but Kaylee was here and she did the state presentation, well, and we talked about apportionment and how you determine about apportionment. Well, the sale, when you have the sale of assets of an entity, so the first one, just to be clear, was the sale or exchange of stock, which you can exclude, gain from the sale or exchange of stock, which you can exclude the gain. That was one. The second thing that I'm talking about is if an entity sells its assets, is the sale of assets sale or exchange stock, Max?
No.
No, except when I handle it. We'll get to that. Okay? If the entity sells its assets, the intangible, like what we were talking about over here, when we had that 743 analysis, there was 4.5 million of intangible, correct? That 4.5 million of intangible, we can do evaluation on that intangible, and we can segregate that intangible into goodwill, customer list, going concern, and various buckets. Goodwill is 100% Nebraska taxable. The other items we can apportion out to other states. So if you're dealing with an asset sale with a multi-state client, how smart are they going to look, McKinsey, if they walk into somebody's office and say, should we do a valuation on this, see if we can exclude gain?
The answer should be yes.
But how smart are they going to look?
Not very.
If they ask the
Oh, if
question,
they ask, yeah.
they look like a genius.
Yeah.
So if you're going to look like a genius, you should probably write down that if you have a sale of assets by a multi-state client, should we ask the question, should we do a valuation of that to get a better tax answer? That is trending towards consulting. In general, what facts and circumstances determine the after-tax proceeds? Why do the rates vary? Federal tax rates vary. C Corp stock, oh fuck, I already did this. Highest capital gains rate of 20% plus Obama net investment tax. Highest rates, maybe, maybe not, because either you're passive or active. Same for the partnership interest. Oh, and this 37% on that previous slide, which is in point 3 at the end, which says ordinary tax at 37%. Why do you think that's there, Sam? The 37% tax to ordinary rates. And we talked about 741 over here and 751. Max?
Sorry, I missed what you said.
Hotel guy? Chris?
We were talking about hot assets.
Hot assets. Okay, that's why that 37% piece is in there. We have to look through the balance sheet, into the balance sheet of the partnership, even if we're selling the equity interest. That's why we have 20%, 23.8% if we're passive, or 37% if we have hot assets, because you're going to have to recharacterize a portion of your gain to ordinary. In general, what facts and circumstances determine after-tax proceeds to the seller? Is the transaction structured as an asset sale followed by the liquidation of C or S corporation with a partnership? Line 1, is it subject to double tax? Oh, what the hell? Is it subject to double tax? C Corp is yes, because the corporation is going to have its corporate level tax, and then when the cash is distributed to the shareholders, they're going to pay a tax on the surrender of their shares or a dividend, whichever the case may be. S Corp's not subject to double tax. Partnership's not subject to double tax because any item of income is going to be reported on the partner or shareholder on their 1040 because they get a K1. That makes it not subject to double tax. So if the entity is selling assets, does purchase price matter? Does purchase price allocation matter? What does purchase price allocation mean? And believe it or not, we've talked about purchase price allocation quite extensively without calling it that. Yeah.
Like when you buy something less than its fair value, you have to, or maybe more, you have to allocate that proportionally across everything to adjust their values.
Have we done that all day, Connor?
Yeah.
When?
When we did that with the 743 sales.
And 734. Okay, so when we went in and we said our equity section was fair market value, you inferred $3 million of value. We tacked on the proceeds, and then we came down to 3.5 million, and then we populated the asset side of the balance sheet with that 3.5 million, and then we contacted our client and said, where does that go? Taking that 3.5 million footed total on the asset side of the balance sheet, which comes from equity plus liabilities, and allocating that in among the assets, that is purchase price allocation. That is a version of purchase price allocation. Okay, so does purchase price allocation matter? Yes or no? For a C Corp, no. For S Corp, yes. For partnership, yes. Does anybody know why it doesn't matter for a C Corp?
All tax the same.
Sorry?
Isn't all C Corp earnings tax the same?
All C Corp, regardless of character, is subject to the same tax rate. That's why it doesn't matter. If it could be 100% capital, it could be 100% ordinary, who cares? It's all subject to the same tax rate. But as we've demonstrated with hot assets, we have an ordinary income rate subject to hot assets. And if we do the purchase price allocation, which Connor helped us with earlier, we could push something to cash basis AR, which is going to cause ordinary income. So to the extent our purchase price allocations pushed to ordinary income asset, we're going to pay higher tax. So for S Corp and a partnership, purchase price matters because we have a varied tax rate. Right, Matt? Correct. Okay, what does double tax mean? How do we get there? Okay, so if we have our C Corp, C Corp is paid $1 million, buyer, and assets are transferred to buyer. Okay, that's the first box there. And that first box says the C Corp is going to get $1 million of proceeds, and it has a 30% tax rate, which is 21% federal rate, and I presume the 9% state rate. So the C Corp generates $300,000 of tax. Now the C Corp has an obligation to send that tax to the IRS. So the bank account went from 0 to $1 million because we got the cash, and then paid $300,000. So our bank account went from $1 million to $700,000 because we paid $300,000 of tax. Now that $700,000 can go out to the shareholder in one of two ways. Either we can buy their stock or redeem it. Right, Chris? Right, we can redeem it, which redemptions are where the corporation or a partnership buys back its own equity interest.
734 transaction.
No, that's a statement, not a question. But I like your enthusiasm. Okay, so the corporation redeems back its stock, so or liquidates or something along those lines, or it can issue a dividend. Okay, and when it does that, $700,000 is going out to the shareholder in redemption. There's a 30% tax rate, which is 23.8%, which is 20% federal rate, 3% NIT, and then 6% state, which is now 5.84, whatever that number is, and $210,000 of tax is due. So $1 million starts here, $300 of tax, $700 is left over to get the shareholder. They ship out the money to the shareholder, $700,000 times 30%, $210 of tax, $490 is left over. So in that very first slide, when we were talking about it, it said, well, what's left over after $1 million sale, assuming 0 stock basis in the corporation's assets and 0 stock basis in the shares of the shareholder? Okay. So I think we can probably skip this slide because we've already talked about purchase price allocation using Connor's example earlier. Okay. So why does purchase price allocation matter? We talked a little bit about this. Accounts receivable are ordinary, assuming they're cash basis. Prepaids are ordinary. Land is likely capital. But Sam, when land's on the balance sheet, what do we have to do? Diagnose. Diagnose. Okay? So land comes in 3 different categories, or possible categories. It could be inventory. It could be held for investment. What was that other one? We talked about it. There was a definition. It was binder 2. What is it? 1245. 1245, that's a subset.
Yeah.
But-
1231.
What?
1231.
1231. It could be 1231. So it could be ordinary because it's inventory. It could be capital because we held it for investment, or it could be 1231. Those would be the options. And Sam, we have to, since we now know something, we can ask questions to
Diagnose.
diagnose which category that land goes into. So the question I would ask is, hey, is this subdivided ground and you're selling it all the time? Yes. Well, that's inventory. Is this land that you bought and you held because you thought something good was going to happen? Yes. It's capital. Is this land that you were going to build a hotel on and it never happened? Yes. 1231. Okay, so you now have a series of questions to
Diagnose.
diagnose what the hell that is. Land is its own weird little thing. Building is, oh man, I wish I had a gift card. First person tell me, I'm going to give him a gift card. 20%, 23%, or 23.8%, or 28.8%. Somebody, oh, give it. First person.
Right, but there's like a 25% tax rate plus the 3.8%.
What? That's half an answer.
It's for the.
Oh no, he's got it. No, and then if he doesn't come out with it, Mackenzie's going to pick a number 1 through 3, and whoever you guys are going to pick a number, and we're going to get there. No, you don't get to look it up. No.
Wasn't it for the 1250? Which one was it? Unrecaptured.
Okay, how do you feel about that, Max?
Unfortunately, pretty good about that.
Okay, that's one of the reasons why. And you guys just shorted 3 a gift card. And actually, for all I care, we might short more of 3, especially since Connor. Nope, don't steal it, Max. Okay, so intangibles, 20 or 23.8%. Okay, in general, what facts and circumstances determine the after-tax proceeds? What are the takeaway from the previous slides? Okay, actually, why don't we take a breath? And since we just gave you a gift card, read what the first thing says. 4.
All right, what are the takeaways from the previous slides? A, as a seller, you want to sell your stock and not the assets of your company. And B, if you are forced to agree to an asset sale, then the purchase price allocation is an important tool to maximize after-tax proceeds.
Does that make sense to you?
Yes,
It does.
somewhat.
Okay. Chris, does that make sense to you?
Kind of.
Kind of?
I don't really think the wording makes sense to me.
Okay, fine. Use your wording.
I can't get my own wording.
Then it doesn't make sense to you.
The answer is no. It doesn't make sense to me.
I'm completely good with that. Connor?
Yeah, for the most part.
Okay, why does it make sense? Oh, no, let's go to CV. He's the one that's inflicting on this. This on us.
don't.
You don't?
No.
Okay. Do you guys remember talking about if something doesn't make sense, to raise your hand and say it doesn't make sense? You get a pass because everybody wants the hell out of here. Okay? So, buying stock of a company, if you go back to the tax, where's the tax rates page?
Page 1.
Page,
Was
what
that
page?
second page in here?
Where is it?
It's like page 2. Yeah,
Page 2?
I think so. Yes.
If you sell the stock of a company, there's 2 things. If you're the seller, there's 2 things that are really good about selling stock, and this is worth knowing. One is the sale of stock is always going to be subject to capital gain with the exception of hot assets under a partnership type of entity. 2, if somebody buys the stock that you have in the corporation, they buy all your damn liabilities. Not meaning bank debt, not meaning AP, meaning if your company has done something it could be sued for, if there's a workers' comp claim, if there's a product liability claim, if there's anything that the company has done that's nefarious, then the person that buys the stock is also buying those problems. So do you think as a seller, getting capital gains rates and getting away from that nefarious stuff, do you think that's a good thing? Okay, so as a buyer, if you buy the stock, You have basis in the stock because that's your acquisition cost, correct? Yes? But do you get to step up the basis of the assets? Let me ask a question. Do you get to step up the basis in a partnership? Why?
Because you're selling to another party.
What election do you have to make though?
754 in either 743 or 734.
754 election, okay? Does that same concept exist for an S Corp or a C Corp? It does not. So selling stock, the buyer says, yippee, I get capital gains, and I potentially get away from whatever my past sins are. And from a buy side, if I buy the stock, I take on their liabilities, and unless it's a partnership, I don't get a step up. That sounds like a bad thing. What's 5 say?
Why would the seller be forced into selling assets versus selling stock? The buyer gets to deduct the purchase price against current income generated. Absent any election/planning, they do not get to deduct the purchase price against current income generated.
Okay. Purchaser prefer to buy assets. Purchaser, why would they prefer to buy the assets? Is because they can get the write-off, and they don't have the liabilities that we talked about. Okay. Let's see. Why is C Corp agnostic? They have the same taxation. Why is it possible for an owner of a partnership or S Corp to be agnostic? Carter, what's agnostic mean?
I don't know.
You don't know?
Uh-uh.
Okay. Allie? CV? You don't know the word agnostic?
I'm
Luke?
borderline like illiterate, you know.
Luke?
I guess it's like almost well, I just think of it about it in a religious sense, but like ambivalent almost.
Yep. Or indifferent. They don't care. Okay, why are they agnostic? Why are they indifferent? Why are they possibly indifferent? The key is in purchase price allocation. If the purchase price is allocated to intangibles, it's very likely, and you probably want to highlight very likely, because it's not 100%, very likely that after-tax proceeds to the seller is the same. If we assume $1 million purchase price for the stock versus $1 million purchase price for equity, the following may result. If we buy the stock, so if we look back over there on the board, you have A owning C1, and I'm going to pretend C1's an S Corp. If A sells its shares, that's this box here. So A sells shares for $1 million, 30% tax rate, $300,000 of tax. If C1 sells the assets for $1 million and is allocated to intangibles or goodwill, well, it's $1 million proceeds, 30% rate, $300,000 of tax. How much tax was paid for the equity interest? Allie?
300,000.
How much if we sell the assets, Allie?
300,000.
If you pay 300,000 under each scenario, would that make you indifferent? It would. So this is why purchase price matters, because it's possible you could be completely agnostic or indifferent as to the structure of the transaction and still get the same tax answer. I don't care about it. There's 754, 99.6, 99.5. I almost can't help myself, but I'm going to. I'm not going to do that. I don't care. Well, I mean, this is stuff. Okay, I'm going to give you a 50,000-foot view. And I'm going to only pick on one item on this page. Because this is, are we here to be, what are we here to be?
Not experts.
Not expert, but build a foundation. So this is 100% just awareness. In the world of tax, there is we play in the land of fiction all the time. And you have to know when and how to play in the land of fiction. So an example is, Carter, do you know anything about a single member LLC?
A little, not a ton.
Okay. Who knows something about a single member LLC? What do you got? So a single, if Max owns a single member LLC, legally, you hold an LLC unit, a piece of paper, it's a certificate of ownership, and that LLC owns ground legally, it's titled to the LLC. Who owns that legally?
The LLC,
Who owns it for tax purposes?
the individual.
The individual. Fuck. So, we live in fiction all the time. Single member LLC, Q subs, they're called, grantor trust, all sorts of things. They are disregarded entities. The DREs, disregarded entities. So that is a fiction. Connor said, basically, that I think, if I'm not Connor, Max owns L1, and L1 owns land. And I think if I was tracking, Max said L1 owns the land legally. So there's a legal entity that owns it. So we're going to call it a piece of hunting ground, and somebody unfortunately gets shot on the hunting ground, and Max gets sued because of that. Well, the LLC is there to be a liability shield against a tragedy. But for tax purposes, Max owns the land. This doesn't exist for tax purposes. It's invisible. It's disregarded. That's the land of fiction. And we have fictions that we confront all the time. So this 330H10 that is here is, let me ask this question. A and buyer enter into a contract to sell C1 stock. They execute on the contract, and A gets $1 million, and A transfers C1 stock. Do we have a stock sale or do we have an asset sale?
Stock sales.
It's a stock sale. Okay, that's 100% right. Now, there's this concept of 330H10 that says that, you know what, this is what we're going to do legally, okay? And this is legal. Max owns the land, or Max owns the LLC, which owns the land, but for tax purposes, Max owns the land. So, if Max sold his LLC interest to Matt purchased legally the LLC interest, but for tax purposes, Max sold the land. Okay, because this is disregarded. In this case, A sold his shares to buyer for $1 million. This 330H10 election is a land of fiction that says, so this is legal reality, and this is tax fiction. The tax fiction is buyer transferred $1 million to C1, and C1 transferred assets. And then C1 liquidated $1 million out to A, and A surrendered the stock. So even though the legal transaction is A sold his shares The tax fiction is C1 sold its assets and liquidated the dollars out. Now, why would somebody do that? Well, A, buyer is going to get a step up. Buyer wants the assets step up. Does anybody see the mouse? Oh, there it is. Okay, so you have a legal reality, which I'm representing on the board. And then you have a tax fiction that says X sold the assets, got an agreed cash, and then X liquidates out the cash to Bob, and Bob surrenders the shares. That's the bottom portion. So the question is, why would one do that? What the hell just happened? Trying to run us out here. Okay, so why would somebody do that? Buyer wants a step up in basis of the assets, and there's problematic assets inside the company. And again, this is getting way closer to expert, and that's why I didn't want to go down this path. So a doctor's practice has lots of Medicare numbers, and applying for those Medicare numbers is a ginormous pain in the butt. So instead of trying to reapply for all those numbers, I will buy your shares of C1 because those numbers reside in C1. And I'm going to buy C1 stock legally because those numbers are still going to reside in C1 because I legally bought C1. But since I did this H10 election, we're going to treat it as an asset purchase that I didn't buy your stock, I bought the assets, and I'll get a step up. You have problematic assets inside of C1 that make the transfer of those assets hard. That's why you would see an H10 or otherwise. Okay. Now, this is going to be the last thing that we end on. Is it getting darker?
The lights are going a little nuts.
All right. Okay, so Nebraska residents can possibly exclude the gain from a stock sale. If Bob sells his shares to buyer, Bob possibly, and Bob's active, could have $1 million of income for federal, 20% tax rate, pay $200,000. Bob, for state purposes, has $1 million of income, 0% tax rate, pay no state tax. So he pays $200,000. If you can meet certain definitions, you can exclude the gain from the sale of your stock in Nebraska if you meet certain definitions. Okay, and those are you know what? This is going back to if there's an intangibles and apportionment. Screw it. We're not going to do it today. No matter what CV does to me, we're not talking about it. Okay, so state consideration, or this is back to state considerations. I'm going to go back over here and say A is selling their shares for $1 million to buyer. Okay? A is selling their shares. Can A exclude the gain generated from Nebraska capital gains? Okay, so let's talk about this definitionally. Nebraska residents can exclude from tax Nebraska capital gains associated with stock. The requirements are the equity interest must be stock in a corporation. Does A have stock in a corporation? Yes or no? Yes. Second requirement, the corporation must have done business in Nebraska for a period of 3 years. I'm going to say that it has. The corporation must have at least 5 shareholders. Does that have 5 shareholders? No, but we can get it there if we want to. I can give a share to McKinsey, to Jackson, and Max, and Matt, and get it there. Okay, that's called the Stewart case. The selling shareholder must receive the shares while employed or an account of employment. While employed or account of employment means I started the business and pulled it out of the ground, or I worked at the business and I got shares while I was employed there. Kiewit in Omaha, Nebraska is a great example of getting shares while employed. It's employee owned. Okay? And then at least 10% has to be owned by unrelated parties. So if you meet those requirements and you sell the shares, so magically if I get C1 with 5 shareholders, and I go A, B, C, D, and E, and this is wife, kid 1, kid 2, and straw buyer. You have to get straw buyer to 10%. I can give stock, A can give shares to his family members and have them count for purposes of the 5 shareholder rule. The 10% person is the trick. Okay? Now, if you see somebody buying or selling something, this is a good thing to know. This is closer to expert than not. Now, the other thing that would be useful to know about this is you can only do this one time. That's it. And so what does one time mean? One time means that it's with respect to one corporation. And that by itself has its own set of analysis that goes with it. So I'm going to say that the corporation was set up that way and I didn't plan into it. I have A, B, C, D, and E. A through D are all related and E is a 10% shareholder. The corporation's done business for a period of 3 years in the state of Nebraska, and A received the shares pursuant to employment. Did I miss anything for my criteria? I don't think I did. Okay? So if A is tired and worn out, kind of like somebody I know in the room, says that we're done. Well, I'm talking about me, not hotel boy.
Boy.
Well, you modified, didn't it?
Not a guy anymore.
Absolutely demoted, Chris. Okay, so I'm going to try to get out of the business. I'm going to step down as we go. So the company buys, I have 100 shares in C1. And in year 1, the company buys 20 shares. And in year 2, the company buys 20 shares, 3 20 shares, 4 20 shares, and 5 20 shares. So over a 5-year period, C1 buys my shares in 5 tranches. Do I have 5 sales for the purposes of the Nebraska capital gain exclusion, or do I have 1? I have 1, because it's with respect to that particular company. You can be bought out of a company over time as long as it's the same company. That's worth knowing. The other thing that's worth knowing is, did you guys do any sort of studies on MFS Worldwide, or WorldCom, and how they were, I mean, that's another fraudulent, they were hanging shit up on a balance sheet. Does that seem familiar to you guys at all? Familiar to you? Okay. Well, okay, let's talk, you guys have heard of level 3. No? I'm so sad. Okay, both those companies were companies that started inside of Kiewit. So Kiewit, I'm going to say, had 3 divisions. It has a construction division, it had a communications division, and then another fiber optic division. So if Kiewit sold, if all the Kiewit shareholders sold their stock for $3 billion, they would meet the requirements, because the company had done business in Nebraska for 3 years, one company, they meet all the requirements. But what they did, for business purposes and otherwise, was they took the fiber optics company, level 3, and spun it out in a tax-free transaction. So now you have level 3 sitting in a separate and distinct corporation outside of Kiewit, and Kiewit still has the phone company and the construction. Now, what happens if the shareholders of Kiewit sell the fiber optics company? Is that 2 companies or 1? It's 1. Because at the end of the day, if I could have sold something at one value at $3 billion, but I spun something out. Now I got $2 billion in one bucket and $1 billion in another. It's all from the same root. And since it's all from the same root, then you are able to take the Nebraska capital gain exclusion on all of it, or on every piece that comes out of there. Nebraska capital gains exclusion, unless it gets legislated out, is a good thing to know. We don't care about this. So that is M&A Basics in a nutshell. And actually, you guys did not look like you were in too much terrible pain going through that. Maybe. And thank you for enduring whatever Free Friday is and having to sit through this and not get your Free Friday.